Hi all, welcome to the weekly market wrap. So we've had a very eventful day today. The benchmark 10-year GSEC rose to 7.27 from its previous close of 7.39. The equity indices saw an upside of 1.5% from its last close. The cheerful day can be attributed to the inflation number of US that was released yesterday. The US inflation number printed at 7.7% versus the market expectation of 8%. As I had mentioned in my earlier videos, one of the major tasks in hand for all central banks is to manage the balance between growth and inflation. So when inflation goes out of the comfort zone, it is imperative for central banks to kind of control it. And we've seen worldwide central bank rushing to increase the interest rates uh, to basically suck out the liquidity in the market and kind of hope that inflation comes under control. So even if the US inflation is lower than market expectation, it is still at near all time highs. But obviously, we can see a glimmer of hope that inflation might kind of come under the comfort zone, and we can see the interest rate cycle reversing, which is what kind of has cheered the markets today. So the markets across the world ended in positive after a while. The Indian benchmark indices were trading higher uh, around when I'm shooting this video for around 2% from its previous close. The US market has kind of recovered all its losses that it saw in last 15 days. And again, the rest of the world ended in positive. Inflation is one of the prime data points which is closely watched these days. Much respite will be provided with the below expectation US inflation number. In India, the inflation outlook still remains weak. The headline CPI inflation is still sticky above the 6% uh, level, which is the upper tolerance band of RBI, for almost 9 consecutive months now. This situation, though induced by a variety of factors, both internal and external, warrants an explanation by RBI to the central government as per new statutory mandate of the MPC. The RBI MPC acknowledges the fact that though the inflation is above RBI's upper tolerance band and uncomfortably high, as seen against the inflation target of 4%, it is expected to moderate to levels of 5.8% by the end of FY23, which makes the forward-looking real interest rate positive. Headline CPI inflation for Q2 FY23 is slightly above 7%, which is below the RBI's estimate of 7.1%, and it is expected to remain above 6% level for Q3 FY23. Globally, there is almost a synchronized policy uh, action against inflation, with a group of advanced economies, central banks hiking interest rates by 50 to 100 basis points. The prudent way ahead will be to stay invested with the right asset allocation strategy that suits investors' risk profile and ignore the market noise. We continue to recommend investors to take advantage of volatile equity markets to their advantage and further invest in medium term fixed income instruments and hold them till maturity to avoid any market risk. This will give investors an opportunity for regular cash flow via fixed income coupons and opportunity to growth and capital appreciation via equities. Happy investing and stay invested.